Tonight, we're going to talk about a company that quietly stands behind much of the modern economy. It doesn't make cars or phones, it doesn't mine gold or drill for oil. Most people have never even seen its name on a storefront, and yet almost every one of us is somehow connected to it. Before we begin, take a moment to like the video and subscribe, but only if you genuinely enjoy these calm dives into hidden parts of history and power. Tell me in the comments where you're watching from and what time it is right now. It's always fascinating to see the map of night watchers around the world. Phone face down, volume low, let's begin. The company's name is BlackRock. It's the largest asset manager on Earth, a kind of financial conductor that manages more money than most countries will ever see. As of this year, BlackRock oversees roughly $11 trillion. That's 11,000 billion, a number so large it loses meaning. To understand it, imagine this. If you gathered the yearly budgets of France, Germany, and Japan, combined them, and still added a few smaller nations on top, you'd be close to BlackRock's scale. It's more than the GDP of every country in the world except the United States and China. And that's just the money it manages on behalf of clients. BlackRock itself owns only a fraction of those assets, but the key is control. Through its funds and holdings, it has influence across thousands of companies. Apple, Microsoft, Exxon, Coca-Cola, Amazon, you name it. Whenever a person invests in a pension fund, buys shares through an index, or contributes to a retirement account, a small part of that money often ends up under BlackRock's supervision. Most of this happens quietly. Each morning, when markets open, the firm's algorithms start moving capital across the planet. They decide how much to buy, how much to sell, and how to balance risk for millions of investors. All of it unfolds behind the scenes, automatic, constant, and almost invisible. To understand just how far that reach goes, consider this. In recent years, BlackRock's investment arm acquired two major port facilities, one on the Atlantic side of the Panama Canal and another on the Pacific. Officially, they're commercial investments, but practically, they give the firm a foothold in one of the most strategic trade corridors in the world, the narrow point where East meets West, where a third of all maritime goods pass every year. That deal alone was worth $23 billion, which in BlackRock's world is barely noticeable. These are not random moves. Through infrastructure, technology, and energy projects, the company gradually positioned itself in nearly every key industry that keeps the global economy running. If the world's financial system is a network of veins and arteries, BlackRock sits close to the heart, monitoring the flow of money that keeps it alive. The firm manages investments for governments, pension funds, universities, and corporations. When a city builds a bridge, when a country issues bonds, or when a multinational expands to a new region, chances are BlackRock is involved somewhere in the background, as a shareholder, lender, or advisor. That's the visible part of the empire: stocks, funds, and ports. But what truly defines its power lies deeper, in the ability to analyze and influence risk across the entire global market. That's where we meet the system at the center of this story, the software that monitors trillions of dollars and tracks global finance almost in real time. The system we mentioned earlier, Aladdin. It's a vast digital network built to measure risk and prevent loss, but over time it became something more, a platform that connects thousands of financial institutions under one set of eyes. Through it, BlackRock can see what few others can: how entire markets breathe, where capital moves, and where fear begins to spread. The existence of such a tool raises obvious questions. How did one private company end up managing a system used by central banks, pension funds, and even rival corporations? who gave it that responsibility, and who, if anyone, can oversee it. These are not conspiracy theories. They're practical questions about scale, trust, and influence. When one firm's decisions can ripple through economies, it becomes more than a business. It becomes part of the global infrastructure itself. So, how did it all start? Who built this empire? And why does it operate in such quiet? To answer that, we have to return to the 1980s, to a single mistake on Wall Street that set everything in motion. The story of BlackRock begins with a failure, not a corporate scandal or a crime, just a simple, devastating mistake that cost one man his career and, indirectly, built a trillion-dollar empire. Larry Fink was born in 1952 in Los Angeles, California. His father owned a small shoe store. His mother taught English at a community college. He grew up middle class, comfortable enough, but surrounded by the values of people who worked for every dollar they earned. It wasn't the kind of background that usually leads to Wall Street. Fink studied political science at UCLA and later earned a master's degree in real estate. In the mid-1970s, the financial world was changing fast. Banks were developing new instruments, mortgage-backed securities, government bonds, complex derivatives. Fink joined an investment bank called First Boston, and there he quickly made a name for himself. He had a talent for numbers, not just for profit, but for structure. He wanted to understand why money moved the way it did. By his early 30s, he was running the bank's bond trading department. Under his leadership, it became one of the most profitable desks on Wall Street. He was known for being disciplined, organized, almost methodical, not the stereotypical risk-taking trader. Then, in 1986, something went wrong. A change in interest rates, small but sudden, threw his models off. Within days, the bank lost about $100 million on trades under his supervision. For Wall Street, that kind of loss wasn't just a number. It was humiliation. One bad calculation erased years of credibility. Fink's rise ended overnight. He was forced out, and the firm quietly moved on. For most people, that would have been the end of the story. But Fink didn't disappear. He started thinking about what exactly had failed, not just in his trade, but in the system itself. The problem, he realized, wasn't bad luck. It was human emotion, the way fear and greed cloud judgment in moments of pressure. He believed finance needed a new foundation, one built on data, risk measurement, and discipline, not instinct. 2 years later, in 1988, Fink and a small team of 7 colleagues started their own company. They rented a modest office in New York and called it BlackRock. At first, it was just another investment management firm, but its goal was different. Instead of chasing quick profits, it would help clients avoid losses. Fink wanted to build a business based on trust, the kind that would survive in bad markets, not just good ones. His idea was simple but powerful. Investors didn't need someone to promise them returns. They needed someone to tell them how much they could lose and when. BlackRock focused on risk management, an unglamorous corner of finance at the time. Most firms sold optimism. BlackRock sold caution. They analyzed how different portfolios would behave if markets crashed or interest rates spiked. If clients could see their risks clearly, they could plan ahead. That was Fink's pitch, and it worked. Within a few years, the company was managing billions. It grew quietly, attracting pension funds, insurance companies, and other institutions that cared more about safety than speculation. What set BlackRock apart wasn't just its performance, but the system behind it. Software that could model thousands of financial scenarios faster and more accurately than any team of analysts. That system would later evolve into Aladdin, the network that underpins much of global finance today. But in those early years, it was simply a way for Fink's team to double-check their assumptions, a tool to avoid another disaster like the one that had ended his career at First Boston. By the mid-1990s, BlackRock had established a reputation for consistency. It wasn't the biggest firm on Wall Street, but it was considered one of the most reliable. Clients trusted it because it never promised too much. And in a business built on confidence, that was gold. Still, for Fink, that wasn't enough. He believed that risk management could become the core of modern finance, that one day every serious investor would have to think the way BlackRock did. All he needed was the right technology to make it universal. And that's where the story takes its next turn. The moment when that modest internal system, originally designed to prevent mistakes, started to grow into something much larger. Something that could analyze not just one firm's risks, but the risks of entire markets. The system that would make BlackRock indispensable to banks, governments, and investors across the world. The key to BlackRock's precision, and to its quiet rise, was the system we mentioned earlier, Aladdin. It started as an internal tool, a way for Larry Fink's team to track risk, but over time, it became the foundation of how the firm sees the world. Aladdin isn't a single computer or a trading platform. It's an ecosystem. Tens of thousands of servers running complex models that simulate what could happen to global markets. It gathers data from everywhere: bond prices, stock indexes, interest rates, currencies, commodity markets, even news feeds. Every few seconds, that information updates, showing not just where money is now, but where it's likely to move next. Imagine you're a pension fund managing the savings of 1 million people. You can log in and see, almost instantly, what would happen to your portfolio if oil prices rise, or if the Federal Reserve raises rates by 0.5%. You can test entire economic scenarios, wars, recessions, climate shocks, and see how each one might ripple through your holdings. That's what Aladdin does. It turns the chaos of markets into something measurable. At first, only BlackRock used it, but soon other institutions wanted access. The system proved so effective that even rival banks and government agencies began paying for it. Today, more than 200 organizations, including the U.S. Federal Reserve, the Bank of England, and major pension funds, rely on Aladdin to analyze risk. Together, those clients oversee more than $20 trillion in assets that flow through its models. That reach gives BlackRock something unique: a bird's-eye view of the entire financial system. When most investors see their own slice of the market, BlackRock's software sees how those slices connect. If a currency suddenly drops in Asia, Aladdin can trace the effect through European bonds, American tech stocks, and commodity prices, all in seconds. It doesn't control what happens, but it knows what's happening almost everywhere. Inside BlackRock, the system is treated as a living organism. Each day, it runs millions of simulations to predict where risks are building up. It can flag a small shift in a bond market that might seem harmless to most people, but signal a potential chain reaction. When the models flash red, portfolio managers take notice, and so do their clients. This is how influence works without ownership. BlackRock doesn't have to own a company to affect its decisions. When millions of investors around the world base their risk management on Aladdin's logic, they start making similar choices. If the model warns against too much exposure to fossil fuels or emerging markets, money flows out of those sectors, not because of orders, but because the numbers say so. In that way, Aladdin quietly shapes the contours of global investment. By the mid-2000s, this tool had become so reliable that even regulators used it to understand their own exposure. When the financial crisis hit in 2008, BlackRock's risk models were already prepared for the kind of meltdown that others never saw coming. That was the moment when governments started calling the company for help. Through Aladdin, BlackRock could analyze the toxic assets that paralyzed banks and show which ones could be saved and which were lost. The system proved so effective that it became a standard tool for crisis response. In the years since, its scope has only expanded. Aladdin now connects thousands of financial institutions through one framework, each feeding it data and receiving guidance in return. For investors, it reduces uncertainty. For BlackRock, it creates visibility no one else has. The firm doesn't need to dictate markets. It just knows how they're feeling before most people do. That knowledge is the real power here, not ownership of companies or resources, but a constant awareness of how money moves and why. It's not a hidden government or a shadow empire. It's a mirror of our economic reality, one that lets a single company see further than almost anyone else. And that brings us to the next chapter, the moment when this knowledge turned into influence on a global scale, when BlackRock's expertise in risk management became a tool for governments themselves. By the early 2000s, BlackRock was already respected in finance, but not yet dominant. What came next changed that. In 2006, the firm made one of the most important deals in its history. It acquired Merrill Lynch Investment Managers. Overnight, BlackRock's size nearly doubled. The acquisition gave the company access to new clients, new markets, and billions of dollars in managed funds. But more than money, it gave them data, years of investment records that fed into their growing analytical system. Then, just 3 years later, another major opportunity appeared, one that no one would have wished for. In 2008, the global financial system collapsed. Major banks like Lehman Brothers fell, markets froze, and panic spread through the world economy. Trillions of dollars in assets suddenly had no clear value. The crisis exposed how interconnected and fragile everything had become. But while most of Wall Street was drowning, BlackRock stayed steady. Its business model, focused on managing risk, not speculation, proved to be the right one for the moment. Larry Fink's team had spent decades preparing for exactly this kind of shock. They had the data, the models, and the discipline that others lacked. That's when the U.S. government called. Through its technology, BlackRock could analyze the toxic assets, the bundles of bad mortgage securities that were collapsing banks. The Treasury and the Federal Reserve needed someone who could look at the chaos and turn it into a map. BlackRock stepped in. Using Aladdin, it evaluated portfolios that other institutions couldn't even open. It showed regulators which assets were still valuable, which were worthless, and which could be saved with time. This process helped the government design the Troubled Asset Relief Program, the massive financial rescue that stabilized the U.S. economy. The company's calm, data-driven approach earned it a reputation that no other firm could match. From that moment, BlackRock was no longer just another investment manager. It was the company governments trusted when everything else failed. In the years after the crisis, that trust became a new kind of influence. When European banks faced their own debt problems, it was again BlackRock that was hired to assess the damage. During the pandemic, when global markets began to slide, the U.S. Federal Reserve called on BlackRock to help structure its emergency bond buying programs. The company didn't just manage assets anymore, it managed confidence. Meanwhile, its growth continued. In 2009, BlackRock acquired Barclays Global Investors, which included the massive iShares exchange-traded fund business. That deal added trillions more under management and turned BlackRock into the undisputed leader of the industry. By the end of the decade, it wasn't simply managing money for banks and pension funds, it was shaping how financial systems understood risk. Governments, regulators, and even competitors relied on its analytics. From then on, whenever there was a crisis, whether in housing, banking, or global markets, the same questions seemed to come up in Washington, London, or Brussels. Should we call BlackRock? It's easy to see why. When you're the only one who can make sense of chaos, people come to depend on you. And in finance, dependence quickly turns into power. What started as a company built on one man's mistake had become something larger, not just an institution, but an infrastructure, a part of how the world manages risk itself. And that shift from private firm to global authority set the stage for the next transformation, when BlackRock began to shape not only markets, but policy and politics. After 2008, BlackRock was no longer just another investment firm. It had become something much more unusual, a trusted technician of the global economy. When a system as large as modern finance breaks, people remember the ones who can fix it. And in the years that followed, that reputation became its most valuable asset. By the early 2010s, governments were still struggling to understand how the crisis had spread so far, so fast. BlackRock, through its Aladdin platform, already had the data to map that contagion, to show, line by line, which portfolios had collapsed and why. So when the U.S. Treasury and the Federal Reserve looked for partners to manage stabilization programs, they turned to the company that had already proven it could handle risk with discipline. BlackRock helped organize the liquidation of assets from failed institutions. It advised central banks on how to unwind the emergency measures that had kept markets alive. And it did all of this not as a public agency, but as a private contractor, one with unique expertise and unparalleled access to data. For governments, it was an easy choice. Hire the team that had already modeled every possible scenario. But this close relationship also blurred the lines between private and public responsibility. BlackRock was still a company with its own investors and commercial interests, yet it now worked side by side with regulators, helping design the very frameworks that governed its own industry. That pattern wasn't limited to the United States. In Europe, BlackRock was soon advising the European Central Bank and national governments on how to strengthen their financial systems. In 2014, the European Commission even hired the firm to review how banks should integrate environmental and social standards into their portfolios. It was a sign of how deeply the company's influence had spread, from markets to policy itself. Inside Washington, the connections grew even closer. Former officials from the Treasury, the Fed, and other agencies joined BlackRock in senior roles, and some BlackRock executives later moved in the opposite direction, entering public service. This constant exchange of people and expertise created a network where the distinction between regulator and consultant became hard to define. When the government needed advice, it called BlackRock, and when BlackRock needed information about upcoming policy moves, it didn't have to look far. Then came 2020, the pandemic, the shutdowns, and the sudden collapse of global markets. Within weeks, the U.S. Federal Reserve launched massive intervention programs to stabilize the economy, and once again, it was BlackRock that was asked to help manage them. The company was given the task of implementing parts of the Fed's corporate bond buying program, a measure designed to keep major companies from running out of credit. Through its experience and its systems, BlackRock helped select and purchase hundreds of billions of dollars in securities. The decisions were made on behalf of the government, but the operational work, the actual buying, flowed through a private firm that already managed trillions in private money. That raised uncomfortable questions. Could a company that invests in the same markets truly act as a neutral agent for the state? Was it possible for BlackRock to separate its role as manager of private wealth from its role as public advisor? The official answer was yes. The firm followed strict procedures to avoid conflicts. But the deeper issue wasn't legal, it was structural. When a company becomes large enough to be essential, its neutrality becomes a matter of trust. Across the Atlantic, similar dynamics played out. In 2021, the European Union hired BlackRock to advise on how to incorporate climate risk into banking regulation. Critics in the European Parliament objected, arguing that the firm's own investments in oil and gas created an obvious conflict. But the Commission defended the decision, saying BlackRock's expertise was unmatched. And that's the paradox at the center of its power. The bigger it becomes, the more the world depends on it, and the harder it is to imagine financial stability without it. At this point, BlackRock was more than a corporation. It was part of the machinery of global finance. Not elected, not official, but woven into the system through expertise and necessity. Its people sat at the same tables as policymakers, shaping the responses to crises that affected millions of lives. This wasn't conspiracy. It was cooperation, born from dependence. But when one firm becomes the default partner for governments around the world, the line between service and influence begins to fade. And that brings us to another form of power, not through policy or crisis management, but through values. The way BlackRock began to shape how companies think, what they invest in, and what kind of world they should build next. By the mid-2010s, BlackRock had become a familiar name inside global institutions. Governments trusted its crisis management. Banks relied on its models. Investors used its tools. But outside these rooms, most people still had no idea what the company was or why it mattered. That began to change when BlackRock stepped into a new arena, one that touched not just markets, but culture and politics. This arena carried 3 letters: ESG. ESG stands for environmental, social, and governance. In simple terms, it's an investment philosophy that says companies shouldn't just make profit. They should also consider their effect on the planet, on society, and on how they are managed. If a company pollutes heavily, treats workers poorly, or has weak oversight, ESG frameworks label it as risky. And if it invests in clean energy, builds diverse leadership, and has transparent operations, ESG rewards it. Larry Fink saw this shift early. He believed that climate risk, storms, droughts, supply chain disruptions would eventually become financial risk. And if investors didn't prepare, they would lose money. So BlackRock began encouraging companies to take sustainability seriously. Fink put this message directly into his annual letters to CEOs, which became something like public guidelines for corporate behavior. He urged companies to move toward renewable energy, to adapt to a changing world, and to think in decades, not quarters. These letters were widely read, not because they were philosophical, but because they came from the largest shareholder many companies had. In practice, when BlackRock spoke, boardrooms listened. If you manage 10 or 15% of a major company's shares, the CEO cares what you think. So when BlackRock said it wanted long-term planning, companies extended their planning horizons. When it pushed for more disclosure on climate risk, companies began publishing environmental reports. This wasn't law. It was influence powered by ownership. Supporters said this was a positive development. If the system is already enormous, Why not use it to steer the economy away from potential disaster? If investors care about long-term stability, shouldn't they encourage companies to avoid environmental and social crises that could hurt profits anyway? But the story isn't that simple. Some critics argued that BlackRock wasn't motivated purely by responsibility, that ESG also made good business sense. By guiding capital towards certain industries, the firm could position itself ahead of major transitions. Its ESG-focused funds grew quickly, attracting clients who wanted ethical portfolios. This wasn't charity, it was a new market. And with trillions of dollars passing through its hands, BlackRock helped define what counted as sustainable. That power sparked a backlash. In the United States, conservative politicians accused BlackRock of imposing a political agenda on private companies. They argued that ESG was a way to pressure energy firms out of oil and gas, key industries for states like Texas. Some states even announced they would withdraw their pension funds from BlackRock as a protest. To them, ESG looked less like risk management and more like social engineering. But on the other side, environmental groups accused a company of not going far enough. They pointed out that despite its ESG commitments, BlackRock continued to invest billions in fossil fuel companies. It voted in favor of some climate proposals, but rejected others. Its critics said the firm liked the image of sustainability more than the sacrifice it required. So BlackRock found itself in a strange position, attacked by both sides. Too political for some, too cautious for others. The truth is more nuanced. As long as global energy systems depend on oil and gas, any large investor will hold those assets. At the same time, they can prepare for a future where renewables grow faster. In that sense, ESG isn't ideology, it's hedging. But the deeper concern wasn't about climate or ethics, it was about power. ESG showed how a private firm could guide the behavior of entire industries. It didn't need to pass laws or issue mandates. A quiet suggestion from BlackRock could be enough. When the world's biggest investor says, "We think you should change," companies adjust, not because they are forced to, but because they don't want their stock to suffer. This raised a larger question. If BlackRock could push companies towards sustainability today, could it push them towards something else tomorrow? Who decides what responsible means? Who defines the priorities, and who benefits from them? Some argued that no private institution, however sophisticated, should have that kind of influence. That decisions about energy, technology, and social policy should come from democratic processes, not shareholder letters. Others responded that governments often move too slowly, while markets respond immediately. If investors see danger ahead, shouldn't they act before it's too late? Both sides have a point, but the debate only highlighted how deeply BlackRock had become embedded in modern life. It wasn't just managing portfolios anymore. It was shaping conversations about the future, how we power our homes, how companies treat workers, and what values economic systems should follow. Whether you see that as progress or overreach depends on your beliefs. But either way, ESG marked a new era for BlackRock, one where financial decisions blended with social ones, and where investment strategy crossed into public discourse. And while people argued over motives, control, and ideology, another quieter question lingered in the background. Who owns BlackRock itself? Who stands behind the firm that influences so much of global capital? To answer that, we need to look at its shareholders, a picture that's far more complex than it first appears. BlackRock is a publicly traded company. That means anyone, you, me, a pension fund, a university endowment, can buy a share. There is no single person or family at the top, no hidden owner pulling the strings. Even Larry Fink, the founder and CEO, owns less than 1% of the company. He runs it, but he doesn't control it through ownership. So who does? The largest shareholders aren't individuals. They're other financial institutions, mostly the same ones that dominate large swaths of the investment world.
At the top of that list are Vanguard and State Street. If you've done any reading about global finance, these names won't be new. Together with BlackRock, they're often referred to as the Big Three. These firms are giants of passive investing, managing index funds and retirement accounts for ordinary people. When someone puts money into a basic S&P 500 fund, odds are it's managed by one of these three firms. So their ownership isn't secretive. It's just the result of millions of regular people investing for the long term. What makes this structure interesting, though, is how these companies hold shares in each other. Vanguard owns a piece of BlackRock. BlackRock owns stakes in many companies that invest through Vanguard. State Street holds positions in both. It forms a kind of triangle, not by design, but by scale. When a handful of firms manage such enormous pools of capital, their paths inevitably overlap. This creates a confusing picture. On paper, BlackRock is owned by other institutions. Those institutions are partly owned by BlackRock. Their clients are ordinary people whose savings flow across the system without them ever knowing it. The result is a kind of circular ownership, where no single actor is in control, yet the same concentrated group appears everywhere. It's easy to see how this leads to speculation. People imagine a hidden hierarchy or a secret agreement. In reality, the structure is a byproduct of modern investing. When the world shifts toward index funds and retirement accounts, the assets concentrate automatically, not because someone planned it, but because the system rewards scale. Still, this concentration raises real questions. If the same firms are major shareholders in thousands of companies, from airlines to software companies to oil producers, who exactly is voting on their behalf? Who decides how those shares are used in board elections, corporate resolutions, and major decisions? Most individual investors never vote their shares. They don't read corporate ballots or participate in annual meetings. That responsibility usually falls to the asset manager. In this case, firms like BlackRock, Vanguard, and State Street.
So, even though they don't own the companies in the traditional sense, they vote as if they do. Their decisions help choose board members, guide company policies, and influence long-term strategy. This is where the confusion begins. If the money belongs to the public, but the voting power belongs to the manager, who is accountable? Who speaks for the millions of savers whose funds are doing the actual investing? The firms respond by saying they follow fiduciary duty, meaning they act in the best financial interest of their clients. And most of the time, this is true. But the fact remains that very few people understand how their money is used once it enters the system. Most assume their retirement account is simply invested somewhere. They don't realize it might be helping shape decisions at companies they've never heard of. This lack of visibility feeds the mystery around firms like BlackRock. People know the company is powerful, but they don't see the mechanisms. They hear that BlackRock owns part of Apple or Exxon, but they don't know what that means in practice. Much of the power is procedural. Voting rights, long-term guidance, quiet conversations, far from the drama of traditional politics. If anything, the ownership structure shows how diffuse modern finance really is. No one person commands it, no small group stands on top.
Instead, trillions of dollars flow through a web of institutions that hold pieces of each other, echoing the same patterns everywhere. This doesn't make the system sinister, but it does make it hard to trace. And when something is hard to trace, people naturally look for clearer answers than the truth can provide. So, if no individual owns BlackRock, and if the company itself is owned by a rotating mix of institutions and savers, then where does the idea of control come from? What are people really reacting to when they talk about BlackRock as an invisible force? Often, they're responding not to ownership, but to perception, to the idea that such a large and interconnected system must have intention, even when it doesn't. That perception becomes even stronger when the story crosses from ownership into myth, the territory of conspiracies and misunderstandings, a space where the facts become distorted and where speculation fills the gaps. Whenever a company becomes this large, public imagination goes somewhere predictable. People look at the scale, the global reach, the political access, and they start to fill in the blanks. In BlackRock's case, those blanks often become stories about a shadow government or a hidden group that controls the world behind closed doors. The internet is full of claims that BlackRock dictates elections, manipulates wars, or controls every major company in secret. There are videos accusing it of running the world economy from a single room, articles insisting that its founder gives orders to presidents, and entire online communities convinced that BlackRock sits at the top of a global pyramid. These stories share one thing in common. They take something real, the firm's size and influence, and then leap beyond what the evidence supports. Let's separate the idea from the reality. Yes, BlackRock manages incredible amounts of money. Yes, it owns stakes in thousands of companies. Yes, it advises governments and central banks. But none of this adds up to a secret world government. The firm's influence doesn't come from hidden commands or political puppeteering. It comes from structure, from the way modern finance is organized. Passive investing is a good example. Over the last few decades, millions of people have put their savings into index funds, simple baskets of stocks that track the market rather than trying to beat it. These funds are cheap, stable, and easy to use. Because of this, they've grown enormously. When people invest in an index fund, they don't pick individual companies. They buy the whole market at once. That means the institution managing those funds, BlackRock, Vanguard, or State Street, automatically becomes a major shareholder in many companies. Not because they targeted them, but because the index requires it. So, BlackRock ends up with shares in Apple, Microsoft, Exxon, thousands more. Not as part of some master strategy, but because millions of ordinary people asked to buy the market. The company doesn't own these firms in the usual sense. It holds shares on behalf of clients. It can vote in corporate elections, but it can't treat those companies like private property. That's why the firm's power is indirect. It doesn't order companies around. It influences them by shaping how investors think about risk, or by guiding what long-term sustainability looks like. Another source of confusion is the relationship between BlackRock and governments. Many assume that because the firm has advised treasuries and central banks, it must secretly control them. But those contracts are public, and they happen because governments don't always have the internal capabilities to analyze complex financial risk. BlackRock is hired not because it rules the system, but because it understands it. You could compare this to hiring a team of engineers after a major bridge collapses. The engineers don't suddenly control the government, they're just the only ones who know how to fix the problem. BlackRock fills a similar niche. It has the tools, the data, and the expertise. That's what makes it valuable, and that's what makes it visible.
Of course, this doesn't mean there's nothing to worry about. The concentration of financial power in a few large firms deserves scrutiny. When one company becomes essential to the functioning of markets, it creates dependency. And when a private firm helps steer public policy, people are right to ask questions about transparency and accountability. But there's a difference between systemic influence and secret control. BlackRock's position isn't the result of hidden meetings or ancient families. It's the natural outcome of decades of financial standardization. As markets became more data-driven and more interconnected, investors turned to firms that could process that complexity. BlackRock was simply better prepared than most. In other words, its power isn't mystical, it's procedural. It comes from the pipes and circuits of finance, the infrastructure that moves money around the world. Most of that infrastructure is invisible to the public. So when people see the effects but not the machinery, imagination fills the gaps. To some, a system this interconnected feels threatening, and it can be. But understanding the mechanics matters. It helps us see that the real issue isn't a secret cabal. It's the structure of modern markets, where efficiency naturally leads to concentration. BlackRock was simply better prepared than most. In other words, its power isn't mystical, it's procedural. It comes from the pipes and circuits of finance, the infrastructure that moves money around the world. Most of that infrastructure is invisible to the public. So when people see the effects but not the machinery, imagination fills the gaps. To some, a system this interconnected feels threatening, and it can be. But understanding the mechanics matters. It helps us see that the real issue isn't a secret cabal. It's the structure of modern markets, where efficiency naturally leads to concentration. The more people invest passively, the more large firms accumulate voting power. The more governments outsource expertise, the more they rely on private advisors. None of this is hidden. It's written into the logic of the system. So the question isn't whether BlackRock secretly controls the world, it's how we should think about a company that has become so deeply embedded in global finance that its absence would cause as much disruption as its presence. And that question leads us to the final part of the story, a look toward the future. What happens when one firm becomes part of the world's financial infrastructure? What are the risks? Where is this heading? And what might change next? Today, BlackRock sits inside the financial world the way operating systems sit inside computers, quietly, constantly, and mostly unseen. Its presence is so normal in professional finance that many people forget it's there at all. And yet, because of that, it's worth asking, what comes next? Over the last decade, markets have become more automated. Trading decisions once made by humans, by teams of analysts arguing in rooms, are now calculated by software. Aladdin was early proof of this shift. It showed that risk could be measured, simulated, and managed by machines faster than any person could ever react. In the future, that process will only grow. More money will be managed by algorithms. More decisions will pass through mathematical models. More institutions will rely on digital lenses to understand the world. This isn't speculation, it's already happening. Many funds place orders automatically, adjusting positions thousands of times a day based on real-time signals. There's efficiency in that, but also fragility. When different firms look at the world through similar models, their choices begin to align. If a signal suggests selling, one fund acts. If many use the same logic, they all act. Suddenly, a small shift becomes a wave. This is the quiet risk of over-centralization. If one company builds the systems that everyone else depends on, and if those systems detect trouble in the same way, then a single miscalculation can echo across the world. Not because anyone intended it,
but because the entire network is connected. It's like having every plane rely on the same autopilot. 99% of the time, it works better than any human. But if there's an error, even a small one, every passenger feels it at once. BlackRock knows this, so do regulators. But the convenience of outsourcing risk analysis is powerful. It's hard to build your own infrastructure when a tested system is already available. And so, dependency grows. What happens if Aladdin fails, even briefly? What happens if a cyber attack shuts down part of its network? What happens if a model misreads a crisis, or if data becomes unreliable? No one really knows. There's no backup system of equal scale. The financial world has built itself on a single map, created by a single firm. If that map goes dark, most institutions would be navigating blind. This doesn't mean disaster is certain. It just means the world is more interlinked and more dependent than ever before. Larry Fink, now in his 70s, still leads the company he founded. For decades, his philosophy shaped how investors think about risk, sustainability, and long-term planning. But eventually, leadership will pass to a new generation, people who grew up inside the system he designed rather than the one he rebelled against. They will inherit a world where BlackRock is not just a firm, but a standard. That transition will matter. Think built BlackRock out of caution, a reaction to failure. His successors will operate from a position of dominance. Whether they guide the company with the same restraint or steer it in new directions remains to be seen. The real legacy of BlackRock may not be its billions or its government contracts. It may be the idea that markets can be made predictable, that uncertainty can be quantified, managed, and contained through enough data. This belief has shaped modern finance. It could define the future. But there's a philosophical question beneath all of this. When we trust models to manage money, when we delegate decisions to algorithms, when we let a single system interpret the world for us, what are we giving up?
Control? Or just illusion? Maybe we feel more comfortable believing that someone or something sees the whole picture. Maybe it's easier to trust a machine than to accept how chaotic markets really are. Or maybe tools like Aladdin allow us to manage complexity in a way humans never could. There's no simple answer. BlackRock isn't a puppet master or a villain. It's a product of the world we built, a world where people wanted safety, predictability, and long-term growth. A world where risk feels less frightening when someone else measures it for us. So, as we look ahead, the question is not whether BlackRock controls the future. It's whether we are comfortable letting any system, no matter how sophisticated, become so essential that we can't imagine the world without it. Because once a single network becomes the default path for global finance, the boundary between guidance and dependence begins to blur. And perhaps that's the real story here. Not a secret ruler in the shadows, but a quiet shift in how the world chooses to understand itself. Thank you for spending this time with me. If you enjoyed this journey, consider subscribing and let me know in the comments what other stories you'd like to explore. Wherever you are and whatever time it is, good night.